Hello everyone, welcome to BISP Solutions. So our next ticket that today we'll be solving is setting up tax rates. Now we'll see how to set up the tax rate in TRCS application. So tax reporting requires you to input the appropriate national income tax rates and regional income tax and apportionment rates at the legal entity level. The tax rate form contains the national and regional tax and apportionment rates needed by the system to compute the national and regional provision for a specific entity. We'll go to application and then configuration. Here you can see the tax rates, click on it. Now you can see this is the national domicile and these are the regional domiciles. That is, national domicile is United States domicile, regional is Alabama, Alaska, California, Connecticut, Illinois, Ohio, and the major which are not identified at the above will be identified at the bottom with the name US blended. You can see prior year current tax rate. So prior year current tax rate, what does that mean? So here we'll be entering the rates, the national statutory tax rate for the prior year. This rate is used for the informational purposes. Then the next is your current year current tax rate. So the national statutory tax rate for this is the national statutory tax rate for the current period. This rate is used in the following calculations. We'll be using this rate to calculate the current provision, the current year activity in the deferred tax roll forward. We'll use this rate in the foreign rate differential in the consolidated effective tax rate report and the current year tax rate change component in the deferred tax roll forward. Then you have opening deferred tax rate non-current. So the beginning of the year deferred tax rate to be used for temporary differences classified as current. This rate is used in the following calculations. Beginning of year deferred tax asset and liability and the beginning of year rate change component in the deferred tax roll forward. The next you have closing deferred tax rate non-current. So the end of year deferred tax rate to be used for temporary differences which are classified as non-current. They are used in the calculation of ending deferred tax asset or liability and the beginning of the year and the current year rate change components in the deferred tax roll forwards. You have here opening regional tax apportionment. So the prior year apportionment percentage to be used by the system in the calculation of opening tax balances in the deferred provision. Then the next is current year regional tax apportionment. The current year apportionment percentage to be used by the system in the calculation of apportioned income in the current provision and tax based on current year activity in the deferred provision. Then you have closing regional tax apportionment. So this rate is the end of year apportionment percentage. This will be used by the system in the calculation of closing tax balances in the deferred provision. Now the next is active region flag. So this identifies a region such as US state for which an income tax provision must be calculated. In order for data to flow correctly between the national and the regional jurisdiction, you must set the archive region flag for each active jurisdiction in the national tax rates to active. So you'll get the drill down button here, you can set it to active. So these all rates will be active. Here you have the POV mentioned, that is scenario, year, period, entity. You can change it by selecting this or by editing from here. You need to select for which scenario, year, period, entity are you applying these tax rates. Suppose if we now the next one is applying deferred tax override rates in the second tab at the top. So this will give you at the top all the POVs, that is scenario, year, period, entity, and jurisdiction. So when entering the tax rates, certain temporary difference amount that or the tax losses, they are tax affected at the reduced statutory rate based on the revenue agency or country level regulations. To account for those deferred taxes, you can evaluate the tax rate by temporary differences based on which when each item is expected to reverse, only the temporary difference accounts and the gap to stat and stat to tax are available. The feature is automatically enabled. However, if no account override tax rate is entered, then the appropriate entity tax rate is applied. You can apply tax rate override for the deferred tax calculations to specific temporary difference accounts. These deferred tax override rates, they are used to apply the blended tax rate in a changing tax rate scenario at account level based on the reversal pattern of the difference. This is different from the current year tax rate, and this will apply on to the deferred tax calculations. If you do not define an override tax rate, the application will use the current year tax rate to calculate the tax. If you do not define an override tax rate, the application calculate the tax on closing members using that rate. If the difference between the current year rate and the override rate are calculated, and then the amount is stored in the corresponding roll forward member. For example, here current year tax rate is 30%, override tax rate is 40%. Pre-tax amount is 10,000, and on on that, if you apply 30%, the tax amount will be 3,000. And now override amount should be 4,000. So the application calculates the automated and adjustment members at the current year tax rate. Then it calculates the difference between current year tax rate and the deferred tax override rate and stores the amount in the automated. So the differential amount of 1,000 will be stored in the automated. The next is override tax, deferred tax override rates regional. So when entering tax rates, certain regional temporary difference accounts or the tax losses are tax affected at reduced statutory rate based on revenue agency or country level regulations. To account for deferred taxes for regional jurisdiction, you can evaluate the tax rate by temporary difference based on which each item is expected to reverse. This is automatically enabled. However, if no account override tax rate is entered, then the appropriate entity tax rate is applied. These are different from the current year tax rate, and they will be applied to the default tax calculations. If you do not define an override tax rate, the application uses the current year tax rate to calculate the taxes. And if you do not define an override tax rate, the system will calculate tax on all the closing member using that rate. This will be applied on the national domiciles. After the default tax override rates are saved for either national or regional, the adjusted override rates are automatically used in the calculations. So first we'll set up the tax rate. Suppose this is our actual year is FY22 period P12 entities operation USD, and we set up a United States. Suppose this is 21% and we set up here to 25%. You can set up the closing rate percentage with the 25%. And this is active. Click on save. Okay. Now, if you go and check to current tax provisional national and package, if you select the same scenario, that is P12 FY22 and operations USD, if you refresh this, now you can see this percentage, it's 25% is being calculated. Earlier it was 21%. Now it got converted to 25% what you have done entered the rate. Now if you go for deferred tax override rate, that means you believe that this rate is not correct or it has been changed. Now you want to override that particular rate. So for that, if you select this, you may enter any of the rate. Suppose I'll be entering in miscellaneous approval. And here enter, instead of 25, I want 30%. I want 40% here, and override closing I want 30%. So first we select the required POV to which this deferred tax override rate applies. Then under override tax rate opening, you need to enter the value for the required override rate. Click on save. Now if you go back to current provision, you will check for miscellaneous accrual. Though our still percentage is 25%, but we just override on the miscellaneous accrual. Okay, I cannot find that account right now. So maybe what I can find is, I'm just searching if I can find the similar account there to check the result. Okay, you can. The fixed asset book depreciation is there, but we cannot find the amount. So I maybe bring this down to base level and see if that allows us. Okay, so on this, so this in this way you do the apply the weights and you can check it over here. If you run the rule for FY22 P12, let's wait for this rule to launch. So you can find the effect of this getting merged at the total tax. If you do the calculation, this will be included by 30% what you mentioned there. That is sorry, the 40% what you mentioned, and it will get included in your total tax. You can check in your deductible income tax. So you can find this 5 lakh difference, and on this amount it will be charged 40%, and it will be clubbed with your current year tax rate, and this gets override because 25% was not calculated. Now it has been calculated with the 40%. So likewise you can establish the tax rates in your application. Now we'll connect with the next ticket in our next session. Thank you so much. Have a nice day. If you have any queries, please contact BISP Solutions. Thank you for your time.